thinking about taking on investors, before you dive in, let me tell you why it might not be the golden ticket that you believe it is. In this video, I'm going to break it down when it makes sense to get investments, but the hidden costs that come with it, and how to set yourself up for the best deal if you do decide to go that route. Let's get into it. The question of when an entrepreneur should get investment is very linked to what they want the business to be. Now, I have rarely gotten outside investment, and that is because I've rarely wanted to do the dance of having to get the investor, then keep the investor happy, and then make scale decisions about the company in order to make sure that the investor is getting the return that they demanded when they put in the money in the first place. To me, that's not a dance that I've ever wanted to do. Now, for some kinds of businesses, you just have to get an investor, right? There's a large capital outlay, or it is a traditional venture capital style business where it's either $1 billion or nothing, right? But outside of those things where you have to because you just need the capital, whether it's for inventory or it's for building a plant or something like that, or in the venture style, most businesses have a choice of whether or not they take on investment. What do you want to do? Is the cost of that capital in terms of giving up equity in the business, in terms of giving up control potentially in the business over time, is that worth it for the acceleration that you get? And I don't think people always think of that in those terms. They're thinking about it in terms of, it would make my life so much easier if I had $500,000 in the bank right now. And that's not necessarily the way that I would think about it, because that you're optimizing then for how easy your life is, not what the financial vehicle is of the company for you. Because ultimately, why does the company exist? The company exists to be a vehicle for you financially. And if you go down the investor route, that could work out very well, or it could work out very poorly. I can't tell you how many founders I know who have started a company, and by the time it exited, they essentially just had a decent paying job for the last 8 years building that company. And they could have done better, honestly, as consultants for that amount of time. The investor myth is a very sexy one, that, oh, I'm real because I got investors. It's kind of a badge of honor. I'm a real business. I got investors. And I actually think the opposite in a lot of ways. It's like, well, you didn't really figure it out without investors. So, taking investment means that you gave away some of your company. I don't think that's necessarily a good thing. It could be, but it doesn't tell me that. So when you take investment capital, it is either based on necessity, or it is you've made a strategic decision that this is the right thing to do, and it's the right trade of you giving away a piece of something that you own in exchange for future opportunity. But I, again, encourage people to think very carefully about whether or not that's a good idea, because sometimes it's the easy way out, and you don't realize how much it's really going to cost you in the future. The concept is, if you try to pitch investors too early and you have no proof, you're going to get a much worse valuation than if you have some proof point first and then you go to pitch. So what is that proof point? The proof point is going to depend on what the business is. So if you're doing something up until recently in AI, you can pretty much be doing anything and they'll just be throwing money at you and it kind of doesn't matter and you get a good valuation. If you're doing something in an industry which is tried and true, they're going to want to know something. For instance, does this marketing actually work? Can you generate a customer? So the question of how much is enough is going to depend on your industry. It's going to depend on the type of investor that you're getting. So friends and family might require a lot less proof than going to a full-time investor, a professional investor of some sort, venture capital, etc. The real answer is the more the better. And the better you can paint a story of this is repeatable and I've de-risked the business, the better you are. Because your valuation is going to be based on the perceived risk that the investor has. And they're going to give you either more money or better terms if they view this as more of a sure bet. So the more that you can de-risk that, and in the company is the thing that de-risks it most, like, okay, I've proven that I can get customers. Well, that might be it, but is this business fundamentally on, can I keep the customers? Or can I deliver X for the customers? What is the financial driver behind that that's going to let you show and paint a picture that I've proven these pieces, and might be more than one. I've proven that I can get customers for $10 per, and I haven't proven lifetime value because it's too short, but I've proven that they'll stay at least this long. Okay, well, that's one thing. Or I've proven that I can get them this result. Okay, well, those are the things that will de-risk it for the investor. And when it's de-risked for the investor, you will get, as a founder, a better investment profile, that you'll get a better valuation, you get better terms when you can actually de-risk it. So that's how I think about it. It really depends on the business, but how have you de-risked it? If you're ready to level up your pitch and get the best possible terms from investors, you need to watch this video where I break down the exact pitch that's helped me raise millions.